Okay, so now we have to work through this a little bit where we're going to say, well, we've got that amount available for savings, and maybe we're going to allocate, they're roughly equal income earners, so we might have to make an assumption or a decision here, and maybe the assumption or decision is that we're going to have half of that amount allocated to each of them. So let's in fact do that. We're going to look at what's available for Jeff to save. And what's available for Tina to save. And maybe we're going to take this amount for saving times 50%. And we could even build a data assumption in here maybe where we could play around with the amount that each of them are going to save. But let's just do 50% here. And Tina's savings, we're going to do the same thing. We're going to take the amount for savings times 50%. And so now we're going to run that all the way across, and we're going to end up using those dollars appropriately. And now we look at Jeff's RRSP contributions. And we say, all right, Jeff is going to put money into the RRSP, and maybe his plan is to max out his RRSP first. Again, there's all kinds of different things we can do here. But let's have him max out his RRSP. So now we are going to go back to the RRSP sheet, and we're going to take his RRSP contributions, and we're just going to base that on, for now, the amount saved. So we're going to pull that back. Sorry. We're going to pull that back from our multi-year cash flow. So we've got Jeff's amount available for savings here. And we can just copy that all the way across. My concern here, of course, is does Jeff ever contribute more than his RRSP limit? So this is where we want to track what's happening with his total contributions versus his RRSP room. So we know we've got his maximum deduction limit here. We know we've got his new deduction limit here. We've already compared those two things. And now what we might do is maybe we insert a row here to say how much deduction room does he have available. And maybe we have a notice of assessment that shows a starting amount of deduction room for Jeff, and whatever it is, let's say it's $12,800, just to have a number. I don't really care what it is, because it's really starting next year that this is going to become important. So Jeff's deduction room next year would be based on last year's deduction room plus last year's new deduction limit, which we already set so that it couldn't be larger than the maximum deduction limit, minus last year's RRSP contributions. So now we're going to watch Jeff's deduction limit grow. And we know he's not maxing out his RRSPs, so we just continue to push that all the way across. Of course, now it doesn't happen until he's actually age 70 in his case, so we're probably not too concerned about it. But I also don't ever want his contributions to be more than what his actual deduction room is. So I can identify that here where we say, all right, Jeff, you can't contribute more than what your available deduction room is. That's an easy enough thing to do. We're going to build a min formula in here where we're going to use the smaller of either the formula we've calculated or his available deduction room. And now we shouldn't end up contributing any more than the available deduction limit. That's good, and we'll come back and fix the retirement stuff. We're not at all ready for that yet, but we can see out here at age 71, he's now never contributing more than his actual deduction limit that's available. Now, we pulled the RRSP contributions from the multi-year cash flow page from column 14 or row 14 here. So now we might say, well, is it possible that Jeff actually ends up contributing more to a savings plan than what we have going into the RRSP? And maybe we say, well, the first thing Jeff is going to do here is use a tax-free savings account. So we're going to call this Jeff's TFSA Contributions. And Jeff is only going to contribute to a tax-free savings account where he's, and this is how we happen to do it for him. There are a bunch of ways we could do this, but we say he's only going to contribute to a tax-free savings account where he's already maxed out his RRSP. So this would only happen if his TFSA contributions, if his RRSP contributions are less than his total amount of savings. So I can build a little formula here where we say, all right, if Jeff's available savings are greater than what he's actually putting into the RRSP, then we're going to take those available savings, and I don't actually need that multi-year cash flow in there, it's referring back to the same sheet, and we're going to subtract what is going into the RRSP, that is, put the surplus here. And if that's not true, that is, if there's not excess money, then there's nothing going into the TFSA. And of course, as always, we're just going to build that out. And we can see now Jeff's TFSA building. And of course, we could do the same thing with the TFSA that we did with the RRSP, where we make sure that he never over-contributes, and we would build a separate sheet for the TFSA around that. So now we've got Jeff's RRSP growing accordingly. Now we should probably figure out what's actually happening in Jeff's RRSP. So this is where we would look at his RRSP balance. And we might have that on a separate assets sheet, or we might just start it here. So let's say Jeff has already $15,000 in his RRSP. And I might do this. I might show my RRSP investment gains as a separate item. And this is where we could take we'll just do the numbers, the new contributions plus the amount that was previously in there, and apply that times some investment return. We already have on our data sheet some investment returns, so maybe this is an all equity investment, okay? Or there are other ways to do this where we say, well, some of that is equity, some of that is fixed income. Maybe we do a separate row here for the return on the RRSP if it's a balanced investment. Or maybe we allocate some weighting right within the formula. There are all kinds of different things we can do. I'm just going to link it back to that 6.3%. And so now we can see the RRSP growing. And next year's RRSP balance then will be based on I don't want to do the 1 plus in here. I just want to do the investment gains. So next year's RRSP balance will be based on last year's RRSP balance plus the contributions from last year plus the investment gains. So now we're going to have $17,008 in there, and we can copy that formula across. And we can watch the RRSP balance grow based on the new contributions plus based on the investment gains. And we should watch that happen here and watch that amount grow up just like so. And hey, that's good news. That RRSP balance gets so big that it's going to take up 7 digits at some point. Hey, good for you, Jeff. And we're just going to make the formula big enough to accommodate all of that. Okay, so now we've got the RRSP balance, we've got the RRSP investment gains. And really, that shows us enough to build any accumulation or increases that we want to build. We're going to stop this video at that point, and in the next video, I'm going to show you how to start working through retirement planning.